Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Monday, October 23rd. It's about 7:30 in the morning, well before the market opens, but I wanted to shoot an update to last week's video. In last week's video, we talked about whether or not the bear was going to reawaken. Well, last week was a pretty negative week, in particular Wednesday, Thursday, and Friday. I'll show you that in a minute or two. So that's what we want to talk about this week, is to give a little bit of an update as to what we see and to also put things in perspective. Now, for those of you that are not familiar with my firm, Hicks Associates Wealth Management, we serve our clients in a proactive capacity. We serve our clients by being intimately familiar with their finances so we can guide their financial decision making with data-backed advice. For most of our clients, we also serve as a portfolio manager, managing their investments in a truly active, fiduciary, and a fee-based approach. If you want to learn more, you can visit our website at hicks-associates.com and just hit the Contact Us button if you'd like to learn a little bit more. That said, let's revisit this chart that we looked at last week. This is the S&P 500 from 1965 through 1979. It is what we refer to as a secular bear market. Within this time period, we saw at least 4 what we call cyclical bear markets or short-term bear markets within a much longer secular bear market. That's why it's called secular. It is a longer duration. And in particular, what we were talking about last week is that we have a concern that we might very well be in an environment like this. However, what we talked about last week was this particular peak right here. So again, here we've zoomed into 1973 and 1974. Again, within the confines of that 1965 through 1979 bear market, this is just zeroing in to 1973 and 1974 because our concern is that this is similar, or this could be similar to what we might very well be experiencing in the days ahead. So again, this is January 10, 1973, the US stock market reached a peak and then it went into a downtrend. So the analogy is, if we compare this on the left-hand side here to 2021, where the stock market was moving higher, but 2022, the market had peaked and we started to go into a downtrend. However, the beginning of this year, really October of 2022, the market hit a bottom. So far it is the bottom, but I'm concerned that it might not be the final bottom. So that's the analogy, is right here we saw in 1973 the stock market was able to rally. It kind of temporarily broke the downtrend, but that's the problem. It was only a temporary break in the downtrend. The overall stock market was not able to repair enough to have a significant change in trend so that the bear right here was taking a nap and he got reawoken. And what ended up happening is 1973 ended up leading right back into another bear market. So that is the concern. And again, the reminder here is that the stock market had already fallen 16.5%. It was able to rally 11, then it fell another 44%. So 2022 was incredibly detrimental to a lot of clients' portfolios. We're quite proud of how we were able to navigate that environment. If you want to learn more, obviously let us know. But we're not necessarily out of the woods just yet. We have talked about this consistently, that underneath the surface there is a lot of weakness. And when we see what we're witnessing right now, this is a very real concern and it dictates a very defensive posture. Now on the screen is the Dow Jones Industrial Average. The problem with the S&P 500 is the S&P 500 really wasn't created until 1950. The Dow Jones Industrial Average is arguably the first, or if not the first, the second index that Charles Dow created. And he created these indexes so that he could measure the overall trend. He can get an overall sentiment of what's happening. Is the overall stock market moving higher, or is it just a few stocks? And so he created the Dow Jones Industrial Average. He created the Dow Jones Transportation Average. We won't get into that. But the point is, the Dow Jones Industrial Average, we have a lot more history on it. And so now on the screen, we have the Dow Jones Industrial Average dating back to 1900. And in particular, what I want to show you is these time measurements. So if we look right here, we can see there's a peak I don't even know what year that is, but you can see we don't really take out that peak again until later in the 1920s. That is a 17-year-long secular bear market. That is incredibly detrimental to an investor. Now, of course, going into the Great Depression, you see the peak. It took 25 years for the market to recover. And then we see the 1960s. This is the area that I've been talking about in that last chart. Again, 16 years. You could argue even longer once you factor in inflation on these charts. Again, this is not inflation adjusted. And then again, we have the lost decade of the 2000s. So the point that we're trying to make is that there is no way of knowing for certain what the next month, the next 6 months, the next 12 months are going to give us in terms of the stock market. And by no means am I making a prediction that we are in a secular bear. That's not the point. The point is, I'm saying that we are concerned that we are in a secular bear, but we are letting the tape, we're letting the stock market tell us how we should allocate. And when we are not being rewarded for taking risk, we're not going to take a lot of risk. Because in general, when we are in a strong bull market, you are well rewarded for taking risk. But in a bear market, the odds are stacked against you, and so we back off the throttle, and so that is what we are seeing. So back to present day, this is the tail end of 2021 is on the screen right here on the left, and then 2022 where we're clearly in a downtrend, clearly a bear market. Want to zero in on this, but before I do, I want to highlight these two black lines. These two black lines represent the peak from August of 2022 and the peak from February of 2023. Now let's zoom in. Again, the black line represents the 200-day moving average. Remember, the 200-day moving average is generally what is considered to be the indicator that we will use to determine if we are in a downtrend or an uptrend. If we're still above that 200-day moving average, then it is generally considered a correction, not necessarily a bear market. But what we see on the left-hand side is we see these last 3 days of last week, Wednesday, Thursday, and Friday. As I believe I indicated, those 3 days, more than 80% of the stocks in the stock market were down for the day. Those are very ominous signs. Now, again, we can't take that and make any firm conclusions, because if we were to study history, and I'm not going to bore you with it, but if you can study history, you will see that when we have 3 really down days like that, there are times where the market will bounce. There are also times where it just keeps falling further. And so we do not know definitively what is going to happen. All we can do is take action based upon what we see. And what we see is right now we're not being rewarded for taking risk. And so we're going to de-risk portfolios for our clients. Now, again, if you look on the left-hand side of the screen, and actually I'll show you here, you can see again the S&P 500 was not able to hold the 200-day moving average in March. The big difference is at that point in the year, at that point in the cycle, the 200-day moving average was still kind of flattening out. Well, now, much later in the year, the 200-day moving average is kind of in an uptrend. And so the fact that we have not been able to hold that level is not a good sign. And so that is a concern. Again, if you look, you can see just with the naked eye, I didn't draw a line, but you can see these levels are very, very similar. So it is entirely possible that the market will rally from here. Now, right now, the futures, again, it's about 813 right now. Futures are pointing to a negative open of about 50 basis points, so not necessarily going to start well. But if we were to go back to October, we saw that the very bottom of 2022, the market opened much lower, and then it had a very strong rally. Entirely possible. I'm not going to make any bets that that's going to happen, but that is certainly possible. But again, we want to highlight the fact that this has been a very tough climate, and there's not a lot of things that have been working. That is why we have been doing the things that we've been doing with the assets that we manage on behalf of our clients. Now, on the screen, we have what's referred to as the value line geometric index. This again is an equal weighted index, and I'll show you what I mean by that in just a second. But again, you don't need to have a designation in technical analysis to see that this is not a strong trend. On the left hand side, you can see this is clearly 2020. The value line was able to rally. We have that peak in 2021, just like you saw in the S&P 500. We have a clear downtrend, but what's happened since then? We have the average stock has been moving sideways, and now I was reading research this morning that the average large cap stock is now negative for the year. This has not been a strong year. Now, we've also talked about the Magnificent Seven. This is an equal weighted version of the Magnificent Seven. And what I want to highlight for you is what happened this last week is the Magnificent Seven has come down to this level, this support level. If this small group of stocks fails to hold that level, I would argue that is not a good sign for the rest of the market, because the analogy that I've been using is Clydesdales. A Clydesdale horse is a draft horse. It's a horse designed to pull a heavy load. Well, that's what the Magnificent Seven have been doing all year long, is they've been pulling the entire S&P 500 higher all year long. Well, these horses are tired. And if we can't get the rest of the stocks to start participating in pulling some of that weight, yeah, I would say that it is very likely that we head right back into a bear market. Now, let me show you what I mean when I talk about cap weighted versus equal weighted. The S&P 500, the index that is typically quoted in the evening news, it is cap weighted. And you can see this is pulled. I pulled this data from Friday, and you can see that Apple represents 7% of the S&P 500. And then Microsoft is at 6.7, Amazon, you can see those top 7 stocks. So what I want to show you right now is what's the difference between a cap weighted and an equal weighted. Top 7 stocks, that's the Magnificent Seven. If you do that math from the prior page, it represents about 26.25 of the S&P 500 weight. If instead you were to say, well, what is it if it was an equal weight? Well, if you take those same 7 stocks, what you're going to see is that it represents about 1.4%. And then you do that, that's just the math. And so there is a big difference between how that small group of stocks can influence the cap-weighted S&P 500 versus that equal weight. If they had an equal measure, an equal influence in the S&P 500 as everything else did, the S&P 500 would be negative this year, and that's what you see in the equal weight measurements. So again, the Magnificent Seven, some people would say that these 7 stocks are the last stocks standing. We could easily make the argument that these 7 stocks have been the only ones standing all year long. This again goes back to the point that we're trying to make, that this is not a strong stock market. This is the Russell 3000. It is going to capture approximately 90-95% of the United States stock market. And on the left-hand side, you can see that only 21% of the Russell 3000 is above the 20-day moving average. Only 15% is above the 50-day moving average. The 50-day moving average is approximately 2 months. And again, the 200-day moving average, again, that long-term indicator, you've only got 31% of the stocks that are above that 200-day moving average. So there is an awful lot of weakness in the stock market. However, don't mishear me. I'm not necessarily saying that you should just go to cash. And again, if you're a client of ours, we're managing this for you already. This is oil. And so what we see in this particular chart is that oil has come back above this 200-day moving average. This is a daily chart. It had a tough week a couple weeks ago, but has been rising. If we can take out this peak here, we would certainly be interested in this. And energy is also still doing okay. it has not had as much damage as the rest of the stock market. So there are good sectors out there. They're just few and far between. So we're not necessarily saying, hey, just go to cash. We would contend that our job is to find that bull market. Generally speaking, there's a bull market somewhere. Our job is to go find it. It's slim pickings right now. This is gold. This is now a weekly chart. And it's a very interesting chart because you can see a multi-year high, so a triple top if you want to call it that. This is an interesting chart. It's had 2 very strong weeks. So anyway, that's enough for now. I think I've gone on long enough. I hope you find these videos helpful. If you haven't hit the subscribe button, hope you would. Feel free to share these with others that you believe might find value. And again, if you have questions, you want to learn more about how we actively manage money for our clients, by all means, visit us at hicks-associates.com and hit the contact us button. Send us a note and we'll be happy to follow up and chat with you. Again, thanks for watching. See you next time.